quickly just introduce the panel. To my immediate left here is Peter Lehner. Peter is Executive Director of NRDC, the Natural Resources Defense Council. He's an environmental lawyer. He's an outdoorsman. He's actually in his second go-round at NRDC, and in between he was an enforcer of environmental laws as head of the Environmental Protection Bureau for the Attorney General here in New York. Next to Peter is Mark Fulton. Mark is Managing Director and Global Head of Research, Deutsche Bank Climate Change Advisors. Essentially, Peter is here with the NGO perspective. Mark is here to represent the banks, the investor perspective. Mark has been a climate change strategist at the bank since 2007. If you recall, that was a time when we could all be very optimistic about where both global and national policy were going. Not so today, so we want to ask him how that's changed his job. And to Mark's, he still does have a job, good. To Mark's left is Paul Simpson. Paul is CEO of Carbon Disclosure Project, which has made a lot of news in the last week or so, releasing their annual both global and US report on companies' attitudes towards carbon. So he can give us an overview of where the big branded global companies are today. And finally, to the far left is Jonathan Schrag. Jonathan is the only regulator actually on the panel. He's the executive director of RGGI, the Regional Greenhouse Gas Initiative, in which there are, at last count, 10, maybe turning to 9 states involved. The only operating cap-and-trade system we have in the US. And before taking over at RGGI, Jonathan was affiliated with the Earth Institute at Columbia, and he was executive director also at Columbia of the Lenfest Center for Sustainable Energy. So Jonathan, I actually do want to start with you. You're a regulator. Briefly sketch out what RGGI is and how it's going, and give yourself a grade on its effectiveness so far.
Okay, thanks for that, and thank you, Andrew, and everyone for having us. RGGI is cap and trade, power sector, in effect since 2008, under design since 2003, the brainchild of Governor Pataki, who happens to be a Republican. And Governor Pataki in 2003 wrote to his colleagues across the Northeast, got together 10 states through 3 years of negotiation, produced a model rule, a memorandum of understanding that each state would put a cap on the CO2 emissions from its power sector. That cap would reduce down 2.5% per year after a period of stabilization, resulting by the end of the program in 2018 in a 10% cut in emissions from the baseline, which was a 2002-2005 average. What has happened after the program has gone into effect is a sort of a tsunami of good news. Natural gas prices are at rock bottom, so there was an enormous amount of fuel switching from coal and oil-fired electricity generation to natural gas, really slashing CO2 emission rates in the power sector across the region. There were economic issues around the recession and a reduction in the demand for electricity. And then finally, the states along the way decided they were going to do this great thing and take all of the proceeds from the auction of CO2 allowances, to date $900 million, and invest them in a range of programs, 50% into energy efficiency. And that energy efficiency spending, together with ERA money, has resulted in additional cuts in CO2 emissions. So as a result, in the first couple of years of the program, RGGI is reported by the analysts to be significantly overallocated. That is, there are too many allowances floating around in the market for actual demand for emissions. As a result, the auction prices, the clearing prices, are at the reserve, at the floor of $1.89. For those of you who are tracking California, you have a sense that the reserve they've put in to regulation is about $10 a ton. So RGGI is an order of magnitude less than California, and although it's a bit crude, that order of magnitude is to some extent used as a proxy for the environmental ambitiousness of the program, the extent to which there's a price signal. So Reggie
Jonathan,
was
just to interrupt you, 189 is what? The price per ton of CO2 emissions?
Right.
Okay.
So, so Reggie was proof of concept, demonstrated the cap and trade could work. Little engine that could, throughout all of the federal debate, 10 northeastern states kept on and have now successfully sort of proven the concept and passed the torch to California. We are at a moment now where Reggie is approaching a program review, an opportunity to restructure, to reinvent itself, spending weekly phone calls with California, talking about how those two programs can optimize and harmonize, potentially working together. I think on the larger question of its effectiveness, we really get into a question of what's the role for policy. Is it to enforce change, or is it to set guidelines and aspirational goals and for business to follow? And I think there is an enforcement component of Reggie. If an electric power company does not purchase allowances and submit them, they need to supply 3 times the deficit amount. And there are enormous state enforcement powers that can be brought to bear. We've seen companies innovate. We've seen them fuel switch. We've seen them voluntarily take action. Now, I don't know you can create an A to B causation, but the good news is that as a result of the states setting out what those policy goals are, we've seen a 35% reduction in CO2 across the region.
So, Jonathan, just to clarify, companies still have to buy the allowances even though in the aggregate emissions are well below the cap
That's right.
for the region.
And
that's at that $1.89 price.
That's right.
And
there are
that's
plenty
a
of
floor
allowances.
price, essentially.
That's right.
Okay, and again, just for folks who haven't paid close attention, it affects major emitters in terms of, utility companies. Any other sources of CO2?
No.
So just utilities. And so the cap is too high to actually drive up the price of allowances today. I think that was designed into the program. It wasn't intended to be a tight cap on day one, correct?
That's correct. I think any cap and trade program is designed to function over time, and so there's a generational payback. You use an on-ramp, making it relatively lax in the early years, and achieve that tightness in the out years. Sending a signal to companies to innovate. I think we are at an order of magnitude more over-allocated than anyone anticipated.
Right, and that was my next question. I saw some charts, I think, that Reggie itself may have produced on one of the Yale climate sites that essentially said that the projections show that emissions will be well below the cap even through 2018. So what are the prospects for ratcheting down the cap in that light? And if they're not bright, what are you actually accomplishing here?
Sure. Well, so those are decisions that would be made by each of the 10 states. Whether New Jersey decides to participate in the next compliance period or not is really a decision for the legislature and Governor Christie, and that decision has not yet been finalized. So the 10 states have to decide that. Next week, I'll go to work for one of those 10 states. I'm moving from Reggie to the state of Connecticut to work for someone who I think is a friend of a lot of people in the room, Dan Esty. But those states need to both individually and as a collective decide where they want cap and trade to go and how strong of a price signal they want to send. I'm relatively optimistic. They've put a lot of political capital into the program, and it is the keystone of the region's environmental achievement, I think.
Okay, but as it stands now, and to just be blunt about it, if there aren't changes made, this isn't going to make a heck of a lot of difference, correct?
Well, $900 million worth of investment in a range of programs, and that's not insignificant.
No, but spread across 10 states, it's $90 million a state. I mean, kind of a rounding error for most state government budgets. I mean, am I wrong, Peter? You give me a quick reaction. Am I too cynical about this?
Yes, I think you are for 2 reasons. One is, if you think about money for energy efficiency, it's a lot. So sure, in the overall New York budget, it's not a lot, but in money for these efforts, which really are critical, because one of the tough things about energy efficiency is it's invisible. And it's hard to see the savings on your energy bill. It's hard to see what good a better insulated house does. You can see the granite countertops, that's nice, but you can't see the insulation. And so these types of demonstration programs are really critical to build up demand for, or I should say, belief in and therefore demand for energy efficiency programs. I think it also shows proof of concept. I think the fact of RGGI did make a big difference in California. And of course, California's Prop 23 was an effort to roll back the California Global Warming Solutions Program, and that was pretty soundly defeated last November, one of the few rays of good environmental news last November. And I think the role of RGGI in showing that a cap and trade can work, it's actually a system that, despite all the political rhetoric going on right now, as Jonathan noted, it was first proposed as a Republican, as a very conservative market-based response as opposed to command and control. And at some point, reality will come back and have a role in the public debate. Right now, it's not got much
And
of a
just,
role.
if I may make another point,
Please.
you know, I think a main criticism of environmental markets over the last 10 years has been that they are too policy determined, and that the jurisdictions that set those policies are overly reactionary to any twinge that they see in the market. That has been a criticism launched at the EU ETS, that they are overly engaged in engineering. And the fact that the states have had the discipline to see this over-allocation, to be very deliberate, hold stakeholder meetings, gather data, and stick to a time frame, a 3-year review process that was set out in the original Memorandum of Understanding, I think really builds an enormous amount of credibility for how cap and trade can function, that it's not going to be a rules-changing dynamic, that jurisdictions experiment with this and experiment with that, but that rather sort of a predictable, here are the rules of the road and we're going to stick with it.
One last question, then I want to move on to Paul. I know it's outside of your jurisdiction, but roughly how many states in the U.S. are in some way or another down the road to a regional climate regulation scheme? There's a bunch besides California in the West, correct?
There are. California is the only U.S. state that is moving forward with deployment of a cap and trade program, a market-based program, together with 3 Canadian jurisdictions, Ontario, Quebec, and British Columbia. There are a number of other states that are observers to that, who over the last 6 to 12 months have decided to wait and see the WCI, those 4 jurisdictions, deploy for the first couple of years, and then make a decision later on about whether to join or not.
So that's Western climate.
That's the Western. The Midwestern Greenhouse Gas Reduction Accord was another group of states who have similarly decided to wait and see how RGGI and WCI deploy. I think everyone is looking at the US EPA and the New Source Performance Standard rules that were supposed to come out the end of this month, and we expect to come out very soon, as a guideline for how states can meet federal requirements. And at that point, we would have 50 states.
Right. Okay. So Paul, you're really coming at this from a whole different angle. You're essentially a coalition of investors who at least are signatories to Carbon Disclosure Project with some, gajillion dollars of assets. How serious they are about deploying them in a carbon-friendly way is a different question. But why don't you, again, give us a sketch of what Carbon Disclosure Project is trying to accomplish, and give us your assessment of how successful it's been so far.
Sure, thanks, Mark. I imagine many of you in the room, looking at their faces, will know CDP, as we tend to call ourselves, but really we organise a global reporting system for companies on climate change, and the leverage for those companies to report on climate change comes from a number of areas, but particularly the investors you've referenced, Mark, now 551 investors with $71 trillion of assets, an awful lot of money that clearly isn't all being spent on invested in climate change solutions. But they are asking the companies to measure and report on climate change. And why are they doing that? That's because there's risks and opportunities to the companies from climate change, not just from policy that we're here on this panel to talk about, but from new technology, shifting consumer sentiment, which is perhaps slower in this part of the world than some others, and also, obviously, new extreme weather events, which we're starting to see more of. So now over 3,500 companies globally report through CDP. They report on a range of information, very specifically what are their greenhouse gas emissions, but also very importantly, what are the risks and opportunities climate change presents to the business? What is their strategy on climate change, and is that really embedded into core business strategy? So we know through our work that measurement does lead to management. It doesn't get us exactly where we need to be, but it's a starting point. And without companies measuring this information, they're clearly not going to act on it. You will see from a number of the other cap and trade schemes that have been coming and are forming around the world that they start by creating a measurement system. Actually, without a measurement system, you can't have cap and trade, in my opinion, certainly, and I think that's the way it's progressing. So what are we really learning from companies? As Mark said, we released our global report last week and our S&P 500 report last night. Both of those are written by PwC. We see that large global corporations, and particularly the brands, as Mark referenced, are very much taking action on climate change. They're integrating it into their core business at a greater level than before. The majority of the Global 500 and the S&P 500 now starting to do that. There is still a group of companies who's not disclosing, who's not really doing anything, but we're seeing a lot of progress ahead of, if we look in the US, the regulation. I know my colleagues on the panel have got some thoughts about this, but the real question is, so why is that? Partly that we're talking about global corporations operating in many countries. There are over 80 pieces of regulation on climate change that affect companies already in place around the world. Some of those are about measurement, some of those are about reduction, some of those are about energy efficiency. So we already have a patchwork of regulation affecting companies. But there are other drivers for companies to act regardless of regulation. You know, rising energy prices, protecting their brand, demands from customers and investors. And what we really see, for those of you who know what a marginal abatement cost curve is, so really, how can you reduce emissions in your business, and will there be a financial return on that, or will there be a long-term cost? The parts of the left-hand side of the marginal abatement cost curve, we see businesses already attempting to make those investments because they will pay back financially and benefit the bottom line, as well as the other benefits of reducing emissions. On the right-hand side of the curve are a whole load of projects companies can do that actually won't pay back financially. Now, companies are not going to make those, and that's where we need policy and where we need initiatives like RGGI to put a price on carbon and shift the projects across the side of the curve. Also, another thing we learn from CDP and the companies we talk to is how they're engaging with policy. So we know that most large corporations are engaging in some way with policy. Companies like to talk about how they're doing that positively, and there is a progressive business voice engaging policymakers to advocate climate change policy. And we see that. But there is also, sorry, Mark.
Well, I guess just to sort of cut to the heart of the question, is the fundamental premise behind the Carbon Disclosure Project working, do you think? In other words, by asking companies to voluntarily disclose and therefore influencing investor behavior, is that model working, do you think?
I think it's definitely working to a point, but it's not going to get us where we need to be. I don't think we have anything in the world yet that's getting us where we need to be on climate change, whether it be regulation or voluntary initiatives. What is working is that companies are measuring on climate change. They are disclosing on climate change, which leads to analysis and is changing some small investment decisions. But really, this is a crucial area that Mark can talk about. How can the investment community move from a short-term horizon to a long-term horizon? Because without that, I mean, this is a fundamental, systemic breakdown. We heard about systems earlier, that the investment community, and including the asset owners, the pension funds, are not investing for the long term. I was with a board member of CalPERS, and we asked him, what's your investment horizon? And he banged the table and said, in perpetuity. The state of California has no end date, right? Which is a fantastic answer, but investors are not investing in this way, right? They're incentivizing people to develop quick returns, and solving climate change, and particularly making these investments on the right-hand side of the curve, is going to need some more action. So what we really see is companies are also setting emissions reduction targets voluntarily. 60% of the 500 largest companies in the world have an emissions reduction target, which they're reporting. And as Bill Clinton said at our launch 3 years ago, well, we have to keep score on how companies are doing that. And at the moment, CDP is really the only global system to do that.
And one last question. Are you, I know what's happening with global emissions in the aggregate, but are you tracking what's happening with CDP reporting companies? Are they, as a group, reducing emissions, stabilizing, or continuing to increase emissions? Do you know?
We do know. They're not one unified group because each year we get more
Different
companies
reporters,
in and
right.
more companies are getting better at measuring their emissions. So the reporting of emissions to CDP is going up as an aggregate, and we'd expect that because there's more companies who are reporting greater coverage of emissions, the Scope 1, Scope 2 and Scope 3. What we do know is that specific companies are reducing emissions. We've assessed companies this year through our Carbon Performance Leadership Index, where they're able to make emissions reductions of 2.65% per annum or more, and there are some companies who are doing that.
Okay. Mark?
Well, okay, so I think this is really a very complicated sort of set of issues. And by that I mean that we're really dealing with the interaction of regulators, investors, and corporations. Mm-hmm. And you've really got to see, at times we'll focus on one group and we'll say, well, it's the investors that really going to, provide the solution because they're going to demand all this stuff. And then the regulators are going to provide it all because they tell everyone what to do. Then the corporations have realized they can make money or not, and they're doing something. That's all of this interacting. And it seems to me at times we lurch towards, as I say, focus on more one than the other. But right now I think it's really interesting because I see, in a sense, the regulators and the policymakers had to kick this thing off. I mean, you had to make sure climate and all sustainability got on the agenda, everybody's agenda, and you couldn't miss it. And you couldn't do that without regulation, without raising that awareness. So even if we never really got carbon prices in some economies, even the debate raised it, and corporations started thinking, do I need a shadow carbon price? So in fact, just the debate about a carbon price can actually cause behavioral shifts if you're forward-looking planner. So I think regulation is about kick-starting, getting it going, getting people focused. Well, who are you trying to get focused? You're trying to get your corporations and your investors focused. Now, I think personally on the corporate side that I'm getting more bullish about corporations themselves really thinking there's something in this sustainability thing and climate thing. And we've been doing a lot of work on a paper we haven't yet released, but to my mind, the overwhelmingly powerful conclusion is that sustainability is highly correlated to the cost of capital. The cost of capital is the big one. Now, when the CFO gets that goes into the boardroom and it goes into the CFO's office. And one of the things that we feel strongly about is that sustainability has to go into the CFO's office. I mean, CEO likes it because you've got to talk about your sustainable company. And then you've got your sustainability officer and so on. But once it gets into the CFO's office, he says, hey, this is going to drive our profits. This is going to drive our risk profile. This is going to get my cost of capital down. My next equity raising is going to be cheaper. My loans are cheaper. My debt's cheaper. Then we're getting pretty serious about a change in behavior. And I actually think that's a really interesting area that we want to focus a bit more on. So you do finally get to us investors, and I think that the investors have it depends who you mean. You've got banks, you've got insurance companies, you've got asset managers, and so on. I happen to be in the asset management division, but I look across the bank, and we have a lot of insurance companies as clients. And each one of those is sort of playing a role, whether it's in the renewables markets, directly financing, could be like us raising certain funds in private equity, in infrastructure, in public equity, and so on. So we're still chipping away, but there's no doubt there's $27 trillion signed up to the Principles for Responsible Investment. And if you said, is that $27 trillion, all of it really, sort of pushing hard on all these sustainability issues, I think we'd all say, no, not yet. But bits of it are, and the real question is, how, will it continue to gather momentum, and we'll see more of that $27 trillion pushing harder and harder and interacting with the regulator and the corporations, so the whole thing's coming together and moving ahead. And then I'll finally, leave my thoughts in this, is the good news is that I think the markets actually are starting to work. And by that, I mean, in particular, I think the costs of renewable energies are starting to fall faster than the latest Moore's curve indicates. And, you know, I've been over at the UN in the last day or so, and there's a lot of guys gathered there for the Energy Access for All. And, you know, you've got some of the big, you know, so renewables companies. And, you know, the numbers coming in on the levelized cost of energy is surprising everybody. So these costs are coming down, and they're coming down rapidly, and they might drop dramatically. Energy efficiency, we're working on how you do retrofit off-balance sheet structures that look like they're going to work. And finally, we might actually crack the retrofit market. Maybe that's coming up in the next year or two. So, you know, ultimately, if you go back to my theory then, the regulator starts, you make all the noise, you do the demonstration, you get it going, and then the corporations start saying, hey, my cost of capital is falling, I want to do something. The investors start saying, yeah, there are returns here, we're starting to invest. Then most importantly, all the cost structures start falling on what you want to do. The finance markets start finding ways of doing this. And one day we turn around to the regulator and say, we don't need you, we're done. Okay, thanks, we're off, this is it. Now, I see people nodding their head. Not in every market, okay? I think new building regulations, should always have regulations on new buildings. But if we can do the retrofit market, we don't need a lot of regulation to do that. Some would be helpful, not a lot. If we get solar PV at utility scale at 6 cents a kilowatt hour, we don't need any subsidies. And how long will that be? 5 to 10 years, in my view. So I think we're in the last phase of the big subsidy ask, which we need to be, because there ain't much money left. So we're staggering through the lot. Hang on, guys, just give us another 5 years sort of thing. And, you know, whether you're a Republican Congress, I mean, it's possible they'll listen to that, you know, whatever people say, you know, it's not all negative news up there. So, you know, if we can stagger through this last thing and then get these costs down, then we go to scale because of the economics.
Well, that's interesting, Peter. Let me get your reaction. I mean, Mark says renewable energy costs are coming down. He says we're beginning to solve some of the financing issues around efficiency. You know, how optimistic are you that we can make progress in this sort of environment of very patchwork and really, frankly, largely not very effective regulation, which we're in now? You would agree with that, right? That the regulations today are really not having much impact.
Well, I think I would probably answer the question depending on how much sleep I got last night. Because
how much did you get?
You can give a very optimistic answer and you can give a less optimistic
Right.
answer. I mean, there's no question that the patchwork of regulations has made a big difference in some ways. The Department of Energy efficiency standards have made a huge difference in our appliance efficiencies, which of course drives a lot. If you think about the CAFE standards, which is policy driven, it took a lot of work through the states originally and then up through. But these were the first fuel economy standards in 30 years. And now we have the path forward to 2025, the first time dealing with trucks. So those are huge steps forward, which will actually spur innovation. And one of the really important things that is often forgotten is as you're looking at innovation in the energy area, there's often ancillary innovation in other areas. So a moribund industry that is not looking at its energy or its pollution tends to be moribund in other areas. And the spurring of innovation has had a virtuous side effect. So you've gotten tons out of the air, you've spurred innovation, you've gotten some companies understanding much more in the private sector, understanding the benefits here. So it has had some advantages. On the other hand, if I have a lousy night's sleep, I think, well, that's all nice, but the science is so strong that we don't have a lot of time, and my goodness, the pace of change is not where we need to be. And even though global solar capacity installed this year is 50% greater than last year, it's still pretty small and is overwhelmed by the new coal plants that China is putting in, or the new fossil fuel plants being installed all around the world. So we still have a long way to go. I guess I would say that I think the way Mark was talking about it is in some ways quite true. You first have policy to get going, and now the business world has woken up and is doing much more on its own. But I would say it's really critical that we not leave policy behind. And it's very easy to think that, oh, great, the business world is there, we don't have to worry about it. And I remember in 1994-ish, when Newt Gingrich was essentially arguing that we're all environmentalists now, so we don't need laws anymore. Well, nice, but, and that's not really true. There's, first of all, a lot of businesses that don't necessarily see the light. And frankly, if you can dump your pollution for free, it's a cost savings. Now, many ways that you can save energy and reduce your pollution will save you money, and will, to a smart company, it presents an opportunity. But there are also ways that simply dumping pollution for free is a cost savings, and you need law to address that. As I mentioned earlier with efficiency, there's a lot of non-price barriers, and I think that's what you're seeing with especially the building retrofits. It makes economic sense, but it isn't happening. And so policy is often needed to get over some of those non-price barriers. And we also have to recognize that to get to where we need to be, history shows that there's been this interplay, technology forcing standards have had a remarkable success. I mean, we all know when we said to get sulfur out of coal-fired power plant emissions, oh my goodness, it was going to cost $1,500 a ton. It cost $50 a ton. Getting lead out of gasoline was going to cost $1 a gallon. It didn't even make a dent in the price of gasoline. You can't put in seatbelts in cars. Every time we've done it, industry has responded. And I admit it's a little frustrating to hear the Chamber of Commerce or representative business basically saying we can't do anything. We're a bunch of incompetents and we can't stop killing people. We can't stop poisoning our planet. We can't stop poisoning our children. And if we do, we're going to collapse. It's pretty pathetic. And frankly, I say this a little bit to all of you as a challenge, we need more business voices saying, yes, this is going to sound tacky, but yes, we can. I mean, history shows that American innovation has worked when the pollution mandates, which are part, I think, of what it means to be an American. You don't have to poison your kids to have a job. Go to China and don't see the sun. American business have responded well. And we need more businesses to start saying that loudly, because you go to Washington right now, that voice is being drowned out. Sure, there are some out there. We work with a lot of them at NRDC, and we bring them to Washington. But I tell you, it's a hurricane of voices on the other side. And we all know the sort of absurdity of I'm nonpartisan, but truly, when one of the major parties are rushing to deny the science of climate change more aggressively than anyone else, there's something surreal about that. And so we really need all of you and all of those that you work with to be much louder, because I know you believe it, but don't assume that truth will out in the time frame that is necessary.
So that's a great look at where we are, both glass half full, glass half empty. Peter, and then I want to go to you, Jonathan. Where do we want to be? Realistically, obviously nothing's going to happen, in 2011 or probably certainly not 2012, maybe not 2013. But what is your vision of what kind of a regulatory scheme? And briefly, I want to ask everybody this. Is it cap and trade? Is it a carbon tax? I mean, what's the long-term goal for NRDC on this?
Well, I would say on the short term, actually, as I said at the beginning, a lot is happening. The appliance efficiency standards, a lot of progress on major areas such as buildings. If you look at the wedges, we're making real progress in those. It's a bit of a mosh right now. Clearly, we live in, and again, history has proven a market-based economy delivers services better than any of the alternatives. So a system that harnesses market forces to reduce pollution, carbon pollution adequately is almost certainly going to be the most effective. We will probably lurch our way there through, as Jonathan was saying, EPA's NSPS, New Source Performance Standards, and other standards up there. At the end of the day, whether it's a cap and trade, whether it's a carbon tax, frankly, for example, if you auction off all the allowances, it comes pretty similar to a carbon tax. And whether if you take that money and dividend it back to people in different ways, whether you spend it on energy efficiency, they're all good solutions. And what we would like, frankly, is a debate on the solutions rather than a non-debate on the fundamental need to address it. And there's a lot of options. There's a lot of smart people out there. So from our perspective, use the market opportunities, use the money-saving opportunities that are out there, and get something going sooner rather than later.
Jonathan, you've been deep in the world of cap and trade for the last few years. Are you more or less of a believer that that would be the best model for national carbon regulation in the U.S.?
I'm strongly supportive of a price on carbon set through a policy mechanism that has environmental integrity, so sets a finite cap rather than a carbon tax. I think RGGI has shown that states can work together to do that. California has an enormous advantage in that it has a market size roughly equal to RGGI, but is a single state and cannot just operationally do things much more quickly. I think that there are enormous things that are going to happen in 2011 and 2012. California is going to deploy its cap and trade program in 2012. That will be an enormous victory for U.S. climate policy and will be a lesson to other states. I also think there are non-carbon regulations that are coming down that may be hard for the public to appreciate, such as rules about mercury. And there are modelers across all of the states who are figuring out which facilities, something between 50 and 75 megawatts, gigawatts, I'm sorry, of coal capacity is going to get shut down in the PJM in the Midwest region. That has SO2 implications for the Northeast, and it has enormous CO2 implications for the country. So there are a lot of levers that the US EPA has and that the states have, and they're pulling all of them.
Mark, Paul, any thoughts on what you'd like, where you'd like us to evolve to? And then I want to ask you how we're going to evolve to there.
Well, so I got to remember we're talking about America, because, you know.
You can talk globally.
Well,
Mark,
no,
that'd be
I'll stay
fine.
in America, because what we try to do is sort of tailor our thoughts to the political reality of whichever country we're looking at. Yeah, right. So, you know, so we wrote what we called an energy plan for America last year, which we thought reflected somewhat of its political reality. So we took it sector by sector, and the first thing we said is what's happening in the coal sector, because the one thing you've got to do is get the major emissions fuel source down. So we did a lot of work on that. We think there's 150 gigawatts. About half of the US coal fleet is over 45 years old and is very inefficient, and certainly a third of it, or a quarter to a third of it, is over 65 years old and is ridiculous, should not be operating. And everybody knows that. So that's where, on a policy level, the hazardous air pollutants are the key, not the carbon price. You'd never get a carbon price quite high enough to knock these guys out, I don't think. But hazardous air pollutants can be very expensive to these old coal plants. So that's the first thing. We think that's one regulatory thing that's very important, we think, to help get the coal retirement going. So once you can see that you could potentially halve coal, what are you going to fill it with? Well, the first thing is renewables could never scale fast enough. I mean, I wish they could, but let's just get real here at the moment. In the grids, the transmissions, and the intermittency issues, you know, we've still got a long way to go. So we've got to use gas as the transition fuel, in our views. Undeniable, in our view, that if gas is not rolled out significantly around the world in the next 20 years, you can't hit any carbon targets. Impossible.
I'm going to interrupt you for one sec. Do you agree with that? I think NRDC is very sketchy on both gas and nuclear, right?
We look, any form of energy has its downsides. Some are inherently more risky than others. In terms of gas, I think we look at it as a risk-reward. There's some areas, yes, that it's just too risky to be drilling in the New York City watershed. The same way that we think you shouldn't be drilling for oil in the Arctic because the risks are too high. On the other hand, if you look at the gas industry, it's surprisingly, they think they're pretty heavily regulated, but in comparison to many other sectors of the American economy, they are not that heavily regulated. And frankly, oversight works. And so we clearly need a much more robust system of safeguards on the whole suite of the extraction process with adequate safeguards. We saw from the BP spill that when the regulators are asleep, corners get cut. And
So
you're going to have this explosion.
Shale gas is okay if properly regulated because of the environmental benefits vis-a-vis coal?
I'm saying it can be okay if properly regulated with adequate oversight in the right places as a transition. I mean, the reality is if you use all that shale gas, we still have too much carbon in the atmosphere. And so one of the, again, troubling issues, and there was just a report put out by the National Petroleum Council that in many ways is good that the industry is saying recognizing we need some better environmental controls, but never recognizing that if we actually burn all that oil and gas, we're cooked. We're cooked, exactly. So we have to keep, as Mark said, it's a transition fuel, and we have to be all the time, not let the gas take our foot off the accelerator on either efficiency, which has far more potential than people think, and ultimately fully clean sources.
Yeah, I agree. I mean, we certainly.
Nuclear a fully clean source?
Well,
Just give me a yes or no, we'll go on to him.
You know, as it is now, no.
Okay.
On the other hand, we actually do support continued research in the area because it is possible that, you know, like other sources of energy, we can figure out a way to do it a lot cleaner than we're doing it now. So one of the challenges, I'm going to push back a little. Everyone wants to have yes/no answers to these things, but in fact, they're often a little complicated. Gas, yes or no? Well, you can't answer quite that way.
Yeah, but you know, if you don't like shale gas today and you don't like nuclear today,
Yes, I mean, that was the point.
it's hard to see how we get from where we are to where we need to go. That's my only
Right, but I think,
pushback
for
view.
example, with nuclear, there are things that you can do to make it a lot better. For example, taking a lot of the fuel out of the spent fuel pools and putting it in dry casks. We see from Fukushima that is an obvious weak point of the plants. That can be done now. It's 20% of our electricity supply. Those plants are going to be around for another 20 years. Let's figure out a way to replace those plants when they reach the end of their life with something that's clean. We have some time to do that, so let's figure that out. Gas, let's figure out how to do it right. We can. I hope New York will do that. We and others are on this advisory committee that Governor Cuomo set up, and if we can figure out a really good set of best practices so that the industry can move forward. And frankly, we keep saying, and at least some in the industry tell us that they agree. They don't want a pitched battle every time they put in a well.
Right.
They want a set of standards so they can move ahead with some confidence.
I'm sorry, Mark, I interrupted you, and then we're running out of time. Paul, I want to get your more global view on where we are regulatory-wise. Go ahead.
Well, just quickly, our modelling indicator without gas, there's no hope, simply put, and I'll argue that any day with anybody.
Without gas?
There's no hope in the next 20 years to hit any climate targets. Ultimately, at the end of it, you actually have to have, hopefully then, you've got gas storage for renewable build-up much more dramatically, or the CCS, which I'm not sure, but one of those has to come in. On the renewable, and it seems to us that in certain countries the gas to coal switch is compelling economically. In other countries maybe not so much, but I think you're going to see a type of coal gas buyout in certain countries. Australia's thinking about that and so on. So I think the gas transition is very important. Then the renewables, you've just got to hope these prices fall very rapidly while you've got this last push for policymakers. And in the United States, I just don't know. It's very worrying if the cash grant goes, then whether the ITC and the PTC, the tax equity market, can really be big enough, it's hard to say. So the United States is playing around with this last 5 years or 10 years of when we need these incentives, and we're not sure if they'll last. But in other countries in the world, those incentives can be quite solid, and there's a large scale-up going on.
Paul.
So, I mean, from my perspective, it's very interesting listening to this debate in the United States because we wouldn't have this debate in Europe. So, firstly, we need to see leadership from the US, and we're not seeing it. We all know that. But that's reflecting on US companies, and we see that in the CDP leadership indexes that US companies are underrepresented. So, I think there's a real risk for US corporations here. We also see, if you look at the renewables, that Asia is the place where renewables companies are growing fastest, and top 10 solar, top 10 wind. If you look at the changes in the last 5 years, very significant shifts towards Asia, US, again, very poorly represented, actually Europe not doing great. But if we look at Europe for a moment, we have significant regulation on climate change. It's not enough. We have an EU emissions trading scheme with a price of about 16 euros a tonne. If we want to switch from coal to gas, I don't think we need to discuss coal to gas, we need to discuss the price. We need a 40 euro tonne price on carbon in the EU to switch from coal to gas. So if the price is right, the market will do its own thing with the fuels. We're a long way from that, so then we start discussing which fuel. But if you take the UK, the government has a mandatory carbon budget out till 2050 of how it will reduce emissions in line with scientific targets. That's a legally binding commitment by the government. And what we really need globally is, I think, loud, long, and legal policy. So loud, it needs to be very clear, long term, so businesses can plan. They can understand this is the trajectory, we don't know all the detail, but roughly this is where we need to get to. And it needs to be legally binding. And I think a final point really to say that, you know, when we get leadership from the US, and I do believe that we will, and when we do, we know that this country is great at innovation and great at solving problems, we will then get a global deal. China, India, other countries, they are ready to talk and they are ready to make agreements. But we all need to do that together globally. And just to echo Peter's remarks, what Christiana Figueres, the executive director at the UNFCCC, said last week at our launch, is that we need the progressive business voice to get better organised, better funded, and to talk louder than the business voice of, you know, particularly the fossil fuel industry, which is blocking regulation. And, you know, this is really the way I would see we need to move forward.
We're out of time, but I want to get one last quick comment from the two Americans on the panel here, Jonathan and Peter. Aside from progressive businesses or even moderately progressive businesses speaking up and being heard, what is your best sense of how the politics of climate change in the U.S. and maybe as part of that, what, if anything, did we learn from the disappointment of 2010, I guess it was. Jonathan, you're in the
There is no politics
world.
of climate change in the U.S. anymore. There's a politics of clean energy.
Okay.
Clean energy and innovation.
So you want to talk about energy, innovation, jobs. You don't want to talk about climate and have that political
That's right.
conversation.
And I think that says it all. That's how the conversation has shifted in the last 6 to 18 months.
You agree? I thought
Yeah,
the
I'm
whole
not
green
sure.
jobs
Yeah.
thing was a total flop in terms of the climate debate. I don't think the environmental groups were credible on the issue. It seemed.
It's not green jobs. It's
Okay.
jobs.
I think it is jobs. It's not green jobs. That's absolutely right. I think it is also health, and I think it is also going to be that we do have to talk a little bit about climate and the moral argument. The very powerful in this country is the evangelical, the religious voice, and they have always, again, been outshouted by those who think if you're for the environment, you're a liberal, and therefore you have beliefs on social issues that we don't like, so we're not going to be with you on the environment. And that's beginning to fall apart. And I think ultimately to get there, we not only need, your question was more than the progressive business voice, it is also many other sectors of society, including those that not just do it for economic reasons, but are doing it for the moral reasons. Many people in this country act for more than just pocketbook reasons. Pocketbook reasons are hugely important, but there are others as well, and we have to get that voice out there, I would say.
Great. I think that's a great way to wrap up. Please join me in thanking Peter, Mark, Paul, and Jonathan.